Hello. Today I'm going to solve a question. This question is taken from the mock exam. The question name is ZOMA. Maybe it was question number 2 or question number 3 in our mock exam. And we are going to solve the first part of the question, only the first part, on request. Well, let's read the question. The question name is ZOMA. Okay, ZOMA is a stock exchange listed company that trades in electronics product. On 1 January 2015, it has granted 1,000 share options to each of its 50 directors, provided that they are still employed by ZOMA on 31st December 2017. Means what? Means there is a vesting period, there is a condition. Directors must be employed by the company on 31st December 2017. Otherwise, they are not eligible for this share-based payment. Okay? So there is this 3 years vesting period. The share-based payment is granted on 1 January 2015, and directors must stay till 31st December 2017. So 2015, 2016 and 2017 directors need to stay for 3 years. That is the 3 years vesting period. So this share-based payment should be recorded over 3 years vesting period. There is another condition. The options will not vest unless the share price becomes $15. Okay. On 31st December 2015, share price was $12, and 31st December 2016, share price was $13. So from this information you say that there is a condition share price should be $15 at least, but the share price is substantially lower than $15. You were expecting that this condition is not going to be fulfilled. Okay, but you need to know what IFRS 2 says. IFRS 2 basically ignores market-based condition. So we are going to ignore this condition. We are going to record share-based payment regardless whether this condition is expected to be fulfilled or not. Now, share options has exercise price of $5 on 1 January 2015. These options had a fair value of $6. 1 January 2015 is the grant date, and grant date fair value of option is $6. However, at the year end, the fair value was 6.5, and at the year end of 2016, the fair value of share option became $7.5 per option. Tax rate is 30%, and tax authority will allow intrinsic value as expense on the exercise date, 31st December 2017. Okay, before that, tax authority is not going to allow this expense. On a particular day, 31st December 2017, this expense is allowed for the tax purpose. By 31st December 2015, 10 directors have left, and ZOMA estimated that another 10 directors will leave before 31st December 2017. So we are expecting that only 30 directors are going to fulfill the conditions. Okay, by 31st December 2016, a total of 15 directors, including those who left in previous year, have left jobs, and it was estimated that another 3 directors will leave. That means we are estimating that a total of 18 directors will leave jobs. That means 32 directors will fulfill the conditions. Our requirement is to discuss with suitable computations how this issue should be dealt in the financial statements of ZOMA for the year ended 2016. Okay, so let's start our answer. First of all, we will write down share-based payment, give some introduction to share-based payment. Okay, so here it goes. Share-based payment is a transaction where entity acquires either an asset or a service, right? So let's write down that. Transaction where entity acquires an asset or a service and the payment is made by issuing shares, share-based instrument, or in cash based on the value of an equity instrument. Here, Zoma acquires service from its directors, and the payment is made by the offer of share option, that is equity instrument. So the transaction is covered by IFRS 2 share-based payments. Okay, that is our introduction over here. After introduction, let's talk about the conditions. So let's write down conditions. Now, over here we need to mention the requirement of IFRS 2. IFRS 2 requires that you recognize share-based payment to the extent you expect that future conditions will be fulfilled. Let's write down it. IFRS 2 requires an entity to recognize share-based payment SBP to the extent future vesting conditions are expected to be fulfilled. Okay, however, market-based conditions are ignored. Fine. So what is the condition in this question? Directors must stay till 31st December 2017, right? So to be eligible for payment, directors must be employed on 31st December 2017. That gives a vesting period of 3 years. You must stay 3 years, 2015, 16 and 17. So the share-based payment is to be recorded over the 3 years vesting period. Now, what is our expectation regarding this vesting period's fulfillment? Over here we say that by 31st December 2015, 10 directors have left, and we are expecting another 10 directors will leave. So on 31st December 2015, 30 directors, that is, let me show the calculation, 50 minus 10 directors already left and another 10 directors are expected to leave, equals to 30 directors are expected to fulfill the condition. On 31st December 2016, how many directors? 50 minus 15 directors already left, and we are expecting that another 3 directors will leave. So equals to 32 directors are expected to fulfill the condition. However, we have another condition, that is share price needs to be $15 at least. Right, the options doesn't vest if share price doesn't become $15. This is our next condition. This condition is ignored because this is market-based condition. Fine. So we have written that far. Our next portion of the answer should be about the measurement. What did we acquire? We have acquired service from the director, right? The acquired item is service from the directors. Here, fair value of service is not reliably measurable. So the measurement should be based on fair value of instrument. Okay, fair value of instrument means we have our option. The measurement should be based on the fair value of the option. It is equity settled share based payment. So grant date fair value of instrument is used for the measurement purpose, and grant date fair value of instrument is $6. That is what we are going to use for the measurement. So we came to this point. Also, we know that the amount should be recognized over the vesting period, and that vesting period is 3 years. So let's write down our measurement. Measured amounts. Now for 2015, how we are going to measure? We have estimated that only 30 directors will fulfill the condition, and we offered 1,000 option to each of the directors, so multiply it with 1,000. Fine. Then this is equity settled share based payment, so we need to take grant date fair value, that is $6, multiplied by elapsed vesting period is 1 year past, that is 31st December 2015 we are talking about. Okay, 1 year past out of total vesting period 3 years, 1/3 we are going to record for this year, and this amount is going to be like $60,000. Now 31st December 2016, we are expecting that 32 directors are going to fulfill the condition, 1,000 option for each of the directors. We take grant date fair value $6 multiplied by 2 by 3, that is the total elapsed vesting period till 31st December 2016. We need to deduct the amount that we have recorded already during 2015, that is 60,000. So the remaining amount is going to be for this year $68,000 approximately, and the accumulated amount is going to be $128,000. Yeah, 128,000. This is what we are going to recognize, right? The amounts are debited to the expense because we have acquired service, so it is going to be salary expense, and credited to other equity because this is equity settled share-based payment, so we credit equity. For cash settled share-based payment, we need to credit liability. For cash or equity settled share-based payment, we need to first credit liability and any balance goes to equity. There's the method. Fine. That is being said, now we are going to talk about tax. Regarding tax, the question says Joma pays tax at 30% and tax authority allows intrinsic value on the exercise date 31st December 2017. Well, so we have a timing difference. There is a timing difference between recognition of expense and recognition of current tax. Recognition of expense and recognition of current tax. Therefore, a deferred tax adjustment is required. On expense, we need to record deferred tax asset. Okay, so we have concluded that we need to record deferred tax asset, and why we need to record deferred tax? Because of the timing difference. Now we are going to explain how we are going to calculate deferred tax for this question. The accumulated tax needs to be allocated to periods following accounting allocation basis, which is same as this accounting allocation basis multiplied by 1 divided by 3 over the vesting period, right? Multiplied by 2 minus 3 divided minus accumulated amount previously recognized. Okay, over the vesting period, we are going to allocate the accumulated tax figure. The amount is measured based on intrinsic value, right? Why intrinsic value, not why the fair value of option on the grant date? Because tax authority is going to allow only the intrinsic value, right? Because tax authority allows this or it, right? It doesn't allow fair value of the option on the grant date, so this time we're going to use intrinsic value instead of fair value of option on the grant date. Now let's calculate intrinsic value. December 2015. You know, intrinsic value equals to share price minus the exercise price, and share price 2015 was $12 and exercise price is $5. So it's going to be 12 minus 5 equals to $7. And 31st December 2016, it is going to be 13 minus 5 is going to be equals to $8. So these are our intrinsic values. Now based on these intrinsic values, our deferred tax asset for 31st December 2015 is going to be equals to, follow the same calculation like this one, 30 multiplied by 100, but we do not take fair value of the option on the grant date. We take the intrinsic value, that is $7, 1/3, and additionally multiply it by tax rate 30%, and that is equals to, let me calculate for a second, 30 1007 multiplied by 1 by 3 multiplied by 30%, that is going to be $21,000. 21,000. Okay, now for the second year, that is 31st December 2016, we need to change this figure. Intrinsic value is 8. Okay, elapsed vesting period now is 2. Also, we need to deduct previously recognized amount, that is 21,000, and the answer is going to be, for the second year, 30,200. 30,200. Fine. Now, whenever we are recognizing deferred tax asset, that means deferred tax asset debit, we need to credit something, and there profit or loss tax credit ceiling is irrelevant, right? So we are going to write down another section, profit or loss tax credit ceiling. So what we are going to write, there is a maximum limit by which profit or loss can be credited by deferred tax asset, and the amount is accumulated relevant expense multiplied by tax rate. So ceiling for 2015 is going to be, how much expense we have charged? 60,000. So it is going to be $60,000 multiplied by 30%, and that is going to be $18,000. Now let's calculate ceiling for 2016 also. Ceiling for 2016 is going to be, how much expense we have charged? 68,000. So let's replace it. 68,000 multiplied by 30%, it is going to be 20,400. So these are the ceilings, right? So as we have this ceiling, we cannot credit the whole amount in this statement of profit or loss, right? So we are going to record these journals. 2015, deferred tax asset debit, 2015 amount is 21,000. Let's pick that amount, $21,000. Tax credit in PRL, maximum 18,000 can be credited in PRL because of ceiling, and tax credit in OCI is the balance, that is going to be 3,000. 18 plus 3 equals to 21,000. And for 2016, let's write down, copy these figures over here. 2016 total deferred tax asset debit is for 2016 30,200. Let me change this figure, 30,200. Tax credit in POL, we have a ceiling 20,400, and the balance goes to OCI. The balance is going to be 9,800. Well, that is for the first part of this question. For 10 marks you need to solve this, right? The tax portion is especially important. If you do not solve this tax portion, then your marks will be significantly reduced. Maybe you will get like 6 or something like that. I hope that this video will help you to solve this kind of question if it comes in final exam.